Good morning, good afternoon, good evening, whenever you are watching this. It's another Wednesday, y'all. Y'all like she knocked these things out. Yes, I did. I had my content because my content is ripe because we in tax season, right? So today's message is gonna be much shorter. I told you last week. Now's a great time to assess your tax liability because we did everything. But let me tell you some takeaways that I want you to think about because I want you to be in the mindset of planning for 2024 now. Why? Because we still got 8 months to get in front of all of this. So, if you get a 1099 NEC or if you get a 1099K, please don't come next year and say, I don't see myself as a self employed person. I'm going to explain to you why. And I want y'all to really truly understand this. The reason why I'm saying this is because the IRS makes us record a 1099 NEC when you're not an employer, you're an independent contractor. You did some services for somebody on a Schedule C, which is part of your 1040. The reason why they tell you to do that is because it's a profit and loss statement. What's happening is that non-independent, not non-employee compensation. That's what an NEC means. Non-employee compensation. You're not an employee, but you receive some money from somebody and they paid you $600 or more. That's what's going to be the flag for a 1099 NEC to be filed on your behalf. So if somebody you work with, you provided services, goods or whatever, 1099 NEC. That's what they're going to give you. And if they give that to you and you are not accounting for the expenses, the ordinary and necessary business expenses associated with that income you received, you are going to have a profit and you are going to end up paying self-employment taxes on top of that profit. That's in addition to the already ordinary tax liability you got. So you're gonna have some additional taxes. And so I want you to know when you're going into this agreements this year, if you're doing independent or freelance work and you're getting a 1099 NEC, you need to be keeping track of the ordinary and or necessary, that's IRS section code 162, expenses related to what it took to earn that income. No, you're not writing off everything. And we're not talking about writing off. We're talking about expenses that were associated with those funds that you earned. So you got to pay attention to this. The same thing is happening with these 1099Ks. Those are credit card transactions that are happening between PayPal and Venmo, etc. You need to be able to say, okay, this was for this, especially if somebody doesn't give it to you in a friends and family capacity. You're going to need to know, did you have any expenses incurred associated with those funds you had? Because come tax time, the Stripe and the Venmo and the PayPal and the credit card third-party processors are going to send that money out if it meets a certain threshold. Anybody who's giving you $600 or more is entitled to, if you're not a corporation, right, or you're not doing stuff with a credit, they didn't pay you with a credit card, they're entitled to report out that they gave you money because it's the matching principle in accounting. What does this mean? That if it's an expense to somebody, it's income to someone else. Think about when you go to, I like to use this example, when you go to Target. What happens? When you go to Target, you go and you purchase a product. That is income to Target, right? But they didn't pay the vendor to store it on, so it's right on the shelf and stuff like that. So they got some inventory and other expenses that they incur. There's a matching principle. And sometimes as business owners, we go to Target to go get supplies, paper, ink, etc. Those are business expenses for us, but that's income to Target. Okay? So I need you to be mindful that if you know that you are going into a subcontractor agreement or if you are doing something and somebody did not select friends and family and it's via a third party processor, be prepared that you are going to end up with a tax document in January of 2025. And you need to have accounted for all the associated ordinary and or necessary expenses that incurred associated with that income that you received. Please, please, please don't tell nobody you're not self-employed, because the IRS gonna definitely charge you self-employed income tax. Whether you feel you were self-employed or not, that information is going to be reported on a Schedule C, I promise you. And you will, if it's a profit, you will incur self-employment taxes. Now, if it's a loss, you're going to be able to leverage that loss against your ordinary income. I promise you, I promise you, I promise you. Know the financial situation that you are in now. Get in front of it. And even if you're just taking notes on a spreadsheet, do whatever you can. Okay, this was associated with this. Or if you got a journal where you can transfer it over. So that way, when it comes to tax time, you can be able to disclose that information to your tax preparer. And I promise you, they'll thank you, you'll thank yourself, and it'll all work out good to go. Y'all probably, she's stuttering. It'll work out good to go in the end. I promise you. Till next week. Peace.